Hello and welcome. In this discussion brought to you by the experts at My Tax Accountant, we're going to tackle a really big topic, capital gains tax on commercial property. We'll make the complex rules simple so you know exactly where you stand.
All right, let's just jump straight in, shall we? Picture this. You've just sold a commercial property. You've made a really nice profit. It's a fantastic feeling. But then, that nagging question pops into your head. How much of this profit is HMRC going to want?
Well, what about this number? 35,280 pounds. Yep, on a profit of 150,000 pounds, your tax bill could be that high. I mean, that is a massive chunk of your hard-earned cash, which is exactly why you need to understand how this all works. But hold on, don't panic just yet, because we're going to break down exactly how HMRC gets to a number like that. And more importantly, we're going to show you the powerful and completely legal ways you can bring that bill way, way down. So here's the game plan for today. First, we'll get the basics done. Then we'll crunch the numbers. After that, the really good bit, how to save tax. We'll also quickly cover rules for different owners and the all-important deadlines before we talk about your next steps. Okay, let's kick things off with Section 1, understanding the basics. Now, the absolute first thing to get your head around is that capital gains tax is a tax on your profit, your gain. It's not a tax on the total sale price of the property. So, what exactly is capital gains tax, or CGT? Well, it's a tax that kicks in when you sell or dispose of, which can also mean gifting, an asset that's gone up in value. And for our purposes today, we're talking about commercial properties, things like offices, warehouses, or high street shops. Look, theory is all well and good, but nothing makes it clearer than a real-life example. So let's meet Sarah. She's a freelance graphic designer based in London, and her story is going to help us see how all these rules work in the real world.
So here's the deal with Sarah. 10 years back, she bought a small workshop for £200,000. Over the years, she spent £20,000 on a big improvement, a new roof. Now, in November 2025, she's selling it for a healthy £375,000. And here's the key bit. Her other income already puts her in the higher rate tax bracket. Let's remember those numbers.
All right, now that we have the backstory, let's get into the nitty-gritty of the calculation. Before you can even think about tax rates, the very first step is to work out what's called the chargeable gain. This is the specific slice of profit that HMRC cares about. You know, the actual formula here is surprisingly straightforward. You just start with your sale price. Then you take away the price you originally paid for it. And here's the bit people often miss. You also get to subtract other allowable costs, like those major improvements or any legal fees. Okay, let's plug Sarah's numbers into that formula. We start with the sale price of $375,000. We subtract the $200,000 she bought it for, then the $20,000 she spent on the roof. We'll also deduct $5,000 for her solicitor and agent fees. And there we have it, a total chargeable gain of $150,000. That's our starting point for the tax calculation. Right, so we have our gain. Now what's the tax rate? Well, for the 2025-26 tax year, it all comes down to your income. If your total income for the year, including that gain, keeps you in the basic rate band, you'll pay 18%. But if you're like Sarah and that gain pushes you into the higher rate bracket, the CGT rate jumps to 24%. And here's a little pro tip for you, something everyone should know about. We all get what's called an annual exempt amount. For the 2025-26 tax year, that's £3,000. It's simple. The first $3,000 of your profit is completely tax-free. We just knock that off the total gain before we work out the tax. Okay, now this is the part you've been waiting for. Seriously, don't go anywhere because this is where the real magic happens. We're about to talk about the game-changing tax reliefs that can slash your bill. Stay with me. This could save you thousands. Let's talk about the absolute king of tax reliefs for business owners. Business Asset Disposal Relief, or BAD for short. This one is a huge deal. If you qualify, it cuts your capital gains tax rate all the way down to just 14%. And that's on gains up to a lifetime limit of £1 million. So the million-dollar question is, does Sarah actually qualify? Let's run through the checklist. Is she a sole trader? Yep. Has she owned the business for at least 2 years right before the sale? Oh yes, 10 years. And was the workshop actually used in her business, not just sitting there as an investment? Absolutely. So the result? A big tick.
Sarah qualifies.
And just look at the impact this has. It's night and day. Without BDR, her tax bill was that scary £35,280 figure. But by claiming the relief, her rate drops to 14%, and the bill plummets to £20,580. That's a staggering £14,700 straight back into our pocket. Absolutely incredible. But wait, there's another really useful tool in the box called rollover relief. This one lets you postpone your tax bill. Basically, if you sell one business asset and use all the money to buy a new one, you can effectively press pause on the tax. It doesn't disappear, but it only becomes due when you eventually sell that new asset. Great for your cash flow.
Okay, so we've focused heavily on Sarah, who's a sole trader. But what if you're set up differently? What if the property is owned by your limited company? Or maybe you don't live in the UK? Let's quickly look at that.
Just a few quick facts for you here. First, limited companies don't pay capital gains tax. Instead, their profit is hit by corporation tax. Second, for non-UK residents, the rules changed a while back, and now you generally have to pay UK CGT just like a resident. And finally, if you own a property with someone else, you each get taxed on your share and you each get to use your own tax-free allowance.
All right, on to the practical stuff, actually reporting this to HMRC and paying the bill. You really don't want to get this part wrong because missing the deadlines can trigger some nasty automatic penalties. So being organised is key.
For a UK resident like Sarah, the timeline is pretty clear. She sells her property in November 2025. That falls into the 2025/26 tax year. The end of that tax year is the 5th of April 2026. She has to report the sale on her tax return for that year. But the final deadline to actually pay the tax owed isn't until the 31st of January 2027. So that brings us to our final point. We've covered a ton of information today, from the basic maths to the really powerful reliefs. But applying all of this to your unique situation, well, that's where things can get tricky, and where expert help is worth its weight in gold. And this quote really says it all, doesn't it? The rules are complex, and the stakes can be really high. Getting professional advice just makes sure you're ticking all the right boxes, and crucially, using every relief you're entitled to. And that, of course, is where the team at My Tax Accountant comes in. This is exactly what they do day in, day out, guiding business owners through capital gains tax and all their other financial obligations. So, if any of this sounds like your situation, or if you just want to get your ducks in a row for the future, please get in touch. You can call the team at My Tax Accountant on 020-857-8531, or you can drop them an email at info@mytaxaccountant.co.uk. And of course, don't forget to subscribe to their YouTube channel for more guides just like this one. And we'll just leave you with one final question to think about. We saw how BTR saved Sarah almost £15,000. But was that the best option? Could rollover relief have saved her more in the long run? What if she owned the property through her company? Every single case is different, and the only way to know for sure is to talk it through. Let's find out together. Thanks for joining us.